Thanks for stopping by. It's Margaret Heaster's The Mortgage Chick. Today, we're going to talk about a brand new government program called Canada's First Time Home Buyers Incentive Program. This is going to launch November 1st, 2019. And what it is the government is going to be helping you with a down payment. They've put aside $1.25 billion for this program. And what it basically is a shared equity mortgage. So they're going to have an interest in your property. So when it's time to cash out, pay them back, sell your house, they're going to also take advantage of your increased property value. But if your property value decreases, they're going to take a little bit of a loss, just like you are. So it is truly a shared equity mortgage. How much are we talking about? If you are looking to purchase an existing home, they will add 5% for a down payment on this property. If it's a brand new home, they will go up to 10%. And if it's a modular home or mobile home, whether it's new or used, they're going to give you 5% to add on to your down payment. So this program is open to a Canadian citizen, a permanent resident, or even a non-permanent resident that's legally authorized to work in Canada. So, to qualify for this program, you obviously have to be a first-time home buyer. Your combined household income cannot exceed $120,000. Your first mortgage and the incentive can't exceed 4 times your annual household income, and the property has to be owner-occupied. Now, that doesn't mean it can't be a duplex, a triplex, or a fourplex, but you do have to live in one of the units. So this program is interest-free. There are no regular payments, and it's completely open, and that means you can pay it off at any time without penalty. What are you responsible for financially? Well, a few things. First of all, you have to have a minimum of 5% down payment from your own money. And what we mean by that is you need 5% from your savings, from an RRSP, or it can be gifted from a family member. You can't borrow the down payment from a family member. You can't put it on your credit card. You can't put it on a line of credit. It's got to be either non-payable gifted or your own savings or an RRSP. So you do have to have your initial 5% down. So this incentive gives you an additional down payment to reduce the monthly cost of your mortgage payments. Now, how does that work out financially? I'm going to look at my notes here because I've got them all written down. So, for example, if you have a purchase price of $500,000, you've got your down payment of 5%, which is $25,000. You would have a mortgage of $475,000. Now, with this incentive program, they're going to tack on another 5% for a down payment. So that's another $25,000. So rather than having a $475,000 mortgage, you're going to have a $450,000 mortgage. So let's look at an example of a 3.5% interest rate. That's going to reduce your monthly mortgage payments by about $150 a month. So let's look at the $500,000 purchase. If you have a 5% down payment and a $475,000 mortgage, your insurance premiums are going to be $19,000. Granted, that gets rolled into your mortgage, but it's still money that you have to pay. If you have a 10% down payment, because the government is giving you the additional 5%, that reduces your insurance premiums to $13,950. So you're saving about $5,000 in default insurance premiums. So there's a big bonus there. Now keep in mind that you do have to pay this loan back. You have 25 years to pay it back, or when you sell your house. If your property value increases, they're going to get a 5% share of that increase as well. So your purchase price of $500,000, they gave you $25,000. When you sell that house and it's worth $600,000, they now want $30,000 back. They want that 5% of the new value. So what is it going to cost you to do this? Well, it's going to cost you a little bit more in legal fees because basically this shared equity is a second mortgage they're going to register against your property. So your lawyer has to register 2 mortgages. Also, when you want to pay them back, you're going to need to pay for an appraisal. You're going to have your property appraised to get fair market value so you can pay back the appropriate amount. So if this is a program you're interested in, I'm sure you're going to have a bunch of questions. So post your questions down below and I will be sure to answer them. If you appreciate my videos, give it a thumbs up. Also subscribe to my channel and ring the bell because you don't want to miss anything. See you in the next video.